Hello and welcome to today's episode of Nucleus Investment Insights. Today, we're going to discuss China's unfolding property crash and the likely effect that's going to have on the world. This week's data release suggests that we've been right on the money in our recent podcast that China is due for an economic correction with respect to its property market. On the agenda, we look at what the team are calling the highway to hell. Next, we'll look at the economic fallout from this unfolding crisis and how this will likely affect markets and any potential political fallout. As always, we have Damien Klassen, who's Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hi, Sam.
And I'd also like to welcome David Llewellyn-Smith, also a co-founder, and he's Nucleus Wealth's chief strategist. Dave, welcome.
Thanks, Sam.
Thanks, guys. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth, and I'll be the host of the show for today. Before we get started, just a quick reminder, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. As mentioned, this is recorded live every Thursday at 12:30 Australian Eastern Standard Time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions you may have, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our shows are available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, I'll hand it over to you, Damo, to get us started.
Thanks. So I think we're described obviously as the crash of the century. I think the important thing to note is that this is a slow motion crash. Like we're seeing it's all happening. It's been happening for some time now. If you look around the world, we've spoken about some of what the great big bubbles are and what where things could go wrong. And this has been one that's been sitting there for a decade or more. And every time it's sort of looks like it's started to fold. There's been another Chinese authority have thrown another round of stimulus at it. What we've seen over the last couple of years was quite a concerted slowdown, sort of in 2019, morphing into a bit more support as the pandemic hit, but it's been pretty consistent in terms of what they've been doing. And so, we wanted to really focus in this week, especially given the Chinese conference to install Xi for life has just occurred, and what it means, or at least what we could see coming out of that in terms of the property sector and where that's taking us. So with that, we'll get across to the highway to hell from Dave and talking about rolling property starts.
So I'd like to add that I don't think it's really all that slow motion.
That's been happening for years now. It's speeding up. It's speeding up now.
Yeah. I mean, certainly what Damo describes as the imbalance has been lurking for a long time, and we've seen fits and starts where we thought it would crash and it didn't, and there have been rescues and new rounds of stimulus, etc. But this one looks for real, and it is in fact outstripping pretty much everybody's projections to the downside. And there is no apparent rescue in sight either. So the highway to hell, I thought I'd just quickly run through some of the data. Firstly, I provided you a chart on Chinese property starts. Now, I should qualify this quickly and say this is not a price crash. This is a property development crash. That is, the volumes of residential construction are crashing. Prices are falling and bleeding lower in some places, worse than others, but it's not particularly a price crash. It is this building crash, which is, even more important for global markets because it absorbs so many commodities, because we're talking a scale of building boom here that the world has never seen before and will never see again. So I'll give you a quick rundown on where we've been and where we've gotten to so far with, the floor area starts, which is the key figure. That is, the amount of building that's happening in terms of square meterage. And so we just had a new round of data for September, and starts were down 44%. but it's probably more important to note that over 2 years and since the peak, so peak to trough, we're down by 65% on starts. So this is quite the wipeout. Again, there appears to be no end in sight, because the leading indicator for starts is in fact land sales, as you can imagine, with developers acquiring land before they go out and build on it, either with pre-sales or other forms of funding. And they're still down 53% year on year, and considerably further from peak to trough. So, they're still leading lower from where we are today. And sales, likewise, peak to trough, are down immensely, but they're still down 24% year on year as well. So on the chart I've written up for you, or drawn up for you, that indicates where we are now. And then basically the little orange line at the bottom and hook, which is roughly the equivalent of the entire 2015 correction. And we thought this was going to happen, but didn't, is still ahead in terms of what these leading indicators are suggesting. So despite this enormous crash, we still have a long way to go, which will play out. That chart plays out until kind of mid-2023. Actually, that might be late 2023. And I've pretty much just used Goldman Sachs's forecasts for sales next year of being down 10%. That's what that chart represents. So it could easily be worse. It might even be a bit better. But there is further to go, and it is material in terms of the volumes of building. So what's the next kind of domino to fall in this? I mean, we've already seen this. So we'll get round to the economic implications, but will we have a banking system crisis is the question I really want to ask on the highway to hell, because obviously any kind of bust of this magnitude, for a boom of this magnitude, which obviously is debt fueled, hugely so, is this going to land on the banking system and I guess become a feedback loop of doom, in which lending starts to fall, or the banks get capital constrained, so that the bust actually gets kind of extraordinarily huge. The answer to that, nobody knows. It's probably no. It would still be my guess, because again, it's not a price bust, so it's not really affecting retail banking. Mortgages are nowhere near as large a slice of business in Chinese banking as they are in Australia, for instance. They're only about a quarter. And so that's, sort of a source of encouragement. That said, the developers are another slice of lending. And then there's all the businesses that are disrupted by the fallout of falling building, that will hit the banks as well. But the main problem for the banks in China on this is not the big ones, the big national banks and the policy banks. It's the regional banks and the smaller banks. They're the ones that do a lot of the lending into these sectors. And so I think we will see problems at that level. And so it probably means that there'll be some kind of pretty serious consolidation at that level of Chinese banking before this thing is over. And, that probably will drive the ongoing adjustment in building, but I don't expect it to result in the kind of subprime crisis we saw in the US, where the entire system is kind of, the solvency is in question. Certainly liquidity problems and solvency problems in regional banks, but, Beijing is likely to bail out where necessary, or use its various mechanisms to resolve those banks. So that's more likely to just let the adjustment roll on and continue to slow growth, both through all that resolution process, which is obviously going to divert lending from more productive outcomes, and the correction itself. So did you want to have a quick word on demographics, just to suggest how structural this all is?
So there's two parts to the demographic side. One is to say, okay, look, let's say China was a normal-sized a normal economy, a normal developed economy, how much building would they actually be doing? So where's the bottom? I guess is sort of that is one question, and the answer is, well, it's still a long way further than where we are now. If you looked at say they were doing the same type of building rate as what you'd say in the US, you could still cut by around about 40% the current levels of building. So keeping in mind that the Chinese property sector has basically got bigger than we've ever seen before in a major economy, and so even though it has fallen almost 50% in terms of the level of building, it was so high that it could come further and still not be extraordinary. And then the question is saying after that is, well, could it fall even further and then just sort of because there's actually lots of inventory out there and sit at low levels for a few years, sort of soaking up the inventory before finally the building started? Absolutely. So, it's more of a question of, in terms of policies, I think, in terms of how far before you start getting policy support from the Chinese government. And so, I would expect that what's shown on this graph is a pretty likely outcome. And could the bottom be a lot further? Yeah. The other thing is China has a rapidly aging population, so and an urbanization profile as well. So we got the latest stats out last year in terms of the Chinese demographics, and what it sort of showed is that the population is aging faster than I think many had thought, and it is also urbanized faster than most people thought. And so which is a good thing in a way, in terms of saying, yes, they're becoming more urban population and fewer sort of peasants sort of working the farms. But on the flip side, they've actually already done more of the urbanization that was expected. And so if you look at the number of people moving into cities, it's still quite high, but we're talking probably sub 20 million a year, whereas it's sort of at its peak, it was 25 million ish a year for that sort of 2013 to 2017 period. It's been a lot lower for the last 5 years than what it was for that. So, just looking at this graph, you can see that sort of 2010 to 2015, there was that big boom of building, and that was backed by being a huge amount of people moving into cities. That next peak, where from 2015 upwards, that was actually a falling number of people moving into cities. And so, if you expect that to continue, and we do expect that to continue because they're already at 65% urbanization rate. The top economies like the US, which we think is probably relatively similar, I guess in terms of a big country with lots of space and spread out lots of different cities, their urbanization is about 82%. So, you would expect that they're not going to approach that at 100 miles an hour. They're going to start slowing. And so, and COVID numbers sort of, I guess, distort it. But, the latest stuff shows that, the urbanization rate has slowed quite dramatically. And so we could be talking about, 10 to 15 million people moving into cities rather than 25, which would, again, put just that alone, takes 40% off your current, the amount of building that's necessary, let alone any overbuilding that's been done. So that's one part. And it's also worth saying as well that there's a number of stats out there and one professor in the US in particular who's on the case on this and keeps posting stuff about how he thinks that China has actually overstated the number of births, and there's all these different measures you can come up with as to how they've overstated births for the last sort of 10 years or so. Now that may or may not be true. The demographics look really bad. Even if you believe all the Chinese statistics, if you think there's any truth to the fact that they've been overstating the youth population, is actually that then makes the whole demographic look even worse. So the UN already has them with a falling population, and the working population is quite likely falling as well, or it's been falling for a number of years. And so everything's sort of lining up on that whole property front to suggest that the tide is going out, whereas the tide was coming in for a decade or two there. And so you certainly shouldn't expect a return to what we saw over the last few years.
And the Chinese authorities are well aware of this, which is why they have, for real, allowed this adjustment to take place this time. I'm sure there are
not
other.
not allowed it, encouraged this.
Well, encourage it. That's
Yeah.
right. Triggered it, in fact, with various policy moves, which they've tried before and backed out of. But this time, those numbers that Damo's describing are pretty definitive. And so, Chinese authorities are really trying to get out of this ginormous building Ponzi scheme before it creates the kind of, catastrophic problems that we sort of discussed a few minutes ago, where possible systemic risk to the banking system, etc. As well as, it's a very unproductive way of developing your economy when you've run out of people, especially. You really are just building this stuff for the sake of building it, digging holes and filling them in, more or less, and that's not going to advance living standards in China. So it'll stall them. So, they're well aware of this, and so are pretty serious about stopping it at this point. So what is the economic fallout? Well, there are various guesstimates of the proportion of Chinese GDP that's taken up by property, somewhere between 25% and 30%. So all of that activity is under intense pressure and will remain so. Well, it's hard to say for how long, but I would have thought at least for the next throughout 2023. And if Damo's point is an important one about inventory, there is a lot of inventory in China. Arguably you could almost stop building now and let the rest of urbanization transpire on your existing stock. You'll have a replacement and what have you as well. But so there is definitely a distinct possibility of an overshoot of less building for a little while.
Well, and actually the stat I like to trot out is, for every urban household in China, for every 6 urban households in China, there is 1 new apartment being built right now. So there is the scale is just incredible.
The scale is incredible. It's something like 14,000 high rises a year. Like it's mind-boggling stuff. So roughly a third of the Chinese economy is hobbled by this, and so that's obviously a big ratchet down in their growth potential. And so an economy that was growing at 6 is looking more like 4, and quite possibly lower than that for a while this adjustment is absorbed. And so in effect, this is China going ex-growth. Property's played a critical role in giving China outsized growth for the last 10 years, as that chart showed, post-GFC especially, and that's coming to an end. So what are the Chinese authorities going to do about it? Well, they're in what we might typically call a liquidity trap. That is because they've triggered this adjustment in their property market and sustained it, like refused to bail it out or throw the kitchen sink at reviving it. They've passed a kind of psychological tipping point in the market where people realise that this is for real, and so they're just not buying these properties anymore as investments and stores of wealth. And as a result, you then start pushing on a string in monetary policy. When you cut your interest rates, people still won't borrow and still won't invest or buy these properties because they don't trust the developers, many of which have been going bust, but they don't trust the government either, because this is all part of Xi Jinping's new vision of common prosperity. And houses are for living in, not speculation. So why would you speculate when the tyrant is telling you not to? So that's kind of formed what we describe in macroeconomics as a liquidity trap, where even if you cut interest rates and make lending cheaper or even more available, it doesn't work. It's called pushing on a string. And so, that's left China with limited options for its central bank to help. It has been cutting rates, and I think it'll be forced to cut them further. But given the magnitude of the bust and the impact that it's had on broader growth, and, we can throw in, zero COVID, making it all worse again, they've actually been quite modest in their stimulus, indeed very modest. So that's because I think they recognise this liquidity trap's there, and so they're going to take it easy on the way down, even if they do more of it. And so that leaves them with fiscal policy as the offset to kind of keep growth going while they go through this property adjustment. And that's been reasonably successful this year. It's stopped, the feedback loops that you would typically get with a massive property bust like this, where it does take down the banking system, lending falls, you get a credit crunch, and then, the whole thing goes to hell in a handbasket.
And that's what I was talking about, the slow motion nature of this in terms of, who was it?
Yeah,
Evergrande had its problems.
Yes. Well, it's slow motion for the economy.
Yes,
and
relative to Evergrande falling over.
Yeah. Like the crash for developers isn't slow motion, but it is for the broader economy.
Yes.
So, absolutely. So that's where kind of our language comes together. So infrastructure has been used to offset the building bust. That is, they're building, roads and ports and railways and lots of kind of new economy stuff as well. Fiber optic and anything you can name, they're building like crazy. And so infrastructure building is up really big over the year. And so that's worked to keep the economy ticking over. However, I've provided you a chart here that from Morgan Stanley, which shows that there are limits to what they're doing in infrastructure. And it's kind of forming, what you might call a fiscal liquidity trap over time, which is a funding gap for fiscal spending. And now, typically, infrastructure in China is deployed via local governments, and they have previously been very dependent on land sales for revenue, as well as other sources of property taxes and things and local activity. And so their budgets have been gutted just as they've been asked to stimulate all this infrastructure. So they've been handed lots of allocations of special bonds and things to build with, which has worked quite well. But there was kind of spare capacity federally in China to do this. And this chart is from Morgan Stanley, shows you more or less what happened this year. And it's kind of about a 1.6 trillion yuan funding gap this year that was filled with spare fiscal resources from Beijing. But it's going to repeat next year. And they've actually run out of headroom on this stuff. So they're going to have to find new ways of borrowing, either creatively or going back, to the sovereign bond markets. And that's, going to potentially cause a bit of dyspepsia in fiscal as well. Look, they'll probably find ways around that. They're very creative at these things, but it does possibly present a market problem for them, wherein they're issuing a lot of new debt. As markets question all sorts of risks around China, property, COVID, and of course now the political economy with, the rise of the tyrant. And so you can see how, if we get some capital outflow in China, then a whole lot of new borrowing fiscally to keep growth going can potentially turn into a bit of a feedback loop of rising interest rates and more capital flight. So,
and your other part is they want the consumer to sort of rise up, so to speak, and start spending more money, and it's a switch from all this investment to letting the consumer take the reins. But consumers in China are very concentrated in the property market. They don't have many other options, and so and on top of that, all the zero COVID and lockdowns and all that type of stuff, they're simply just not spending, and you'd expect if property prices continue to fall. They're not about to come out of the shell anytime soon.
No. And of course, the other thing that's kind of developing as we speak, and I expect to get worse, is, China's enjoyed this extraordinary trade boom for the last few years during COVID, and that's now going bust globally. Global trade has started to fall in volume terms. It's already falling in Korea, which is a great bellwether for this, and it's likely to be doing so in China very soon, and I think will intensify over 2023. And so this is another shock coming to China, just as it's trying to manage all of these various property, fiscal, and monetary risks. So it's a difficult situation they find themselves in. And so we might turn to markets at this point. Damo, and see how this could play out. Oh, sorry, no, we're doing. Oh yeah, we're going to do some commodities first. Here's the fun part. So yeah, markets and political fallout. First up, iron ore. So, if you'd have told me that Chinese property starts would fall 65%, peaks to trough, and iron ore would still be near $100 a few years ago, I would not have believed you. But that's the situation we're in, and there are some very interesting factors for why. We've already described infrastructure. That's played a role in stimulating demand for steel, and so offset some of the property downturn. But the larger factor in this is that basically the Chinese steel producers have idled an enormous quantity of steel recycling capacity. And so there are two types of kind of steel output in China. One of them is typical blast furnace, and that is creates pig iron from iron ore. And that's certainly the dominant form. But what has been happening over the last decade is that electric arc furnaces, which is steel recycling using electricity, has been rising basically through policy prompting, and it had virtually doubled over 10 years, from nearly immediately post GFC to where we were, at the height of the COVID output. The Chinese plan, the current 5-year plan, was to continue that process and grow it again by another 50%. That is the steel recycling capacity. But instead, what has happened is that it's been halved, virtually halved. And what that means is pig iron output has been stable. And so basically, Chinese steel recycling has absorbed an enormous amount of the downturn in steel demand. So that's allowed typical iron ore input steel which has certainly fallen, but it's remained a lot higher than I would have expected in these current circumstances if you'd asked me before it happened. So those are the two main reasons that iron ore has held up. I mean, when I say held up, it has crashed from $230 to like $88 today, and it's now at post-COVID lows and falling. So don't get the wrong idea.
No, and it halved over the last 9 months or so.
It did. So it's falling, but the simple fact is I would have expected a massive shakeout in global iron ore if I'd been told that China's property was going to fall that far.
Yeah, and in context, in 2015, it fell to sort of similar levels to where we are today, a little bit higher. Yeah. And the iron ore price was $30. Yeah,
or 38 it bottomed out at. Yes. So I do not expect iron ore to hold up. It may well be that the nature of the adjustment coming to iron ore is less precipitous than what happened in 2015. It may not crash, but if it doesn't, then it's going to grind lower anyway, I think. And there are a couple of factors for why that is. Basically, I don't think, infrastructure investment is a bit of a pig in the python. That is, you get a big lump of it and then it kind of passes through the system and you finish a bunch of projects. And so suddenly, your offset in demand collapses. So I do expect them to continue with the infrastructure, but I don't think it can keep growing year on year. So that'll be lumpy, but it won't grow much in a year on year broad sense. So that's the first issue. Secondly, there has been a lot of investment this year, huge investment growth from manufacturing following the export boom. Lots of building new factories and things. So that's another source of steel demand. And that's obviously going to follow global trade down. So I expect there'll be a big CapEx downturn for China over 2023. And of course, we'll have the ongoing property falling starts. So, the factors that have held up or helped prop up steel demand are going to decline, I think, as the property bust continues. So that's the first factor. the second is the global economy is entering perilous terrain, and so I expect not only no offset for elsewhere, demand for steel around the world will probably fall as well. Thirdly, there's still more iron ore supply coming. Next year, it's somewhere between 40 and 50 million new tonnes, largely from Australia, a little bit from Brazil. About almost half of it comes from Fortescue, who are launching a new mine in the start of Q2 next year. It'll take a year or so to fully wind up to full output, but it's definitely coming in. And then Rio and BHP have incremental gains coming. They've got a lot of new mines and stuff, and same with Vale. And I think that stuff will arrive, despite their protestations about being disciplined on investment. They're incrementally going to increase their output. So that's next year, and then the following year there's even more. This time more from Brazil than Australia, and so over the 2 years it's probably about 100 million more tonnes of iron ore that's coming. And if we see what I think we will in Chinese demand over 2023, I think that's probably about 100 million tonnes of demand that will disappear. So over 23 and 2024, we could see a swing in the market balance of anywhere up to 200 million tonnes towards surplus iron ore. Now, there are swing factors in there. We might see the entire electric arc furnace fleet in China shut down. I find this hard to believe, but then I would never have believed that they'd shut half of it. So they could continue with that, and that would absorb, half of that and help support some of the iron ore prices. But
and just as likely it could come back if they sort of.
The moment the price rises, it comes back. I mean, that's what's been happening.
I guess there's an argument that it uses more electricity, and so if you had a choice between the two and you're worried about electricity prices, then you shut those irons off and you just pay the extra cost on iron ore.
Yeah.
But if those prices start to come down and you add more.
Look, I think that's probably the key to why the mills are doing it. But I mean, China, and it was certainly the case when it started in this process of using electric arc furnaces as kind of swing production. Over COVID, China found itself very short of coal in kind of 2021. And so a huge coal price takeoff and electricity price takeoff. And it all made sense then to shut EAF steel. But they've largely resolved that through a huge increase in coal output, which really shouldn't please anyone, but it is what it is. And they've caught up with that now, and electricity prices are reasonable, and yet here we are, and it's still a lot of it shut down. So I don't know. I mean, global scrap prices have come down a lot from where they were in 2021. They're probably still not as cheap as iron ore, but they're sort of falling together. And at some point, I mean, if the Chinese authorities are remotely interested in decarbonisation, then they are going to have to resume going after higher electric arc furnace output. But who knows?
And in a long, ignoring short-term complications with electricity prices and things like that, it is cheaper. It's far cheaper to recycle steel than what it is to
it is. All things equal, yes, it is. So. So the outlook for iron ore is pretty gloomy. I'm not really putting price targets on it, but I would have thought that the price will need to be low enough to shake out, highest cost marginal supply through 2023, and that's got to be at $60, as a ceiling, and then pick your downside from there.
Yeah, I would say most would be producing. Most of the big ones are producing sort of $45 without too much of a problem. So,
oh, absolutely. Yeah. I mean, the really big ones are
30.
Way below that. But the high cost marginal stuff will need to be shaken out. And I think that's coming over 2023. So I'm not positive about the iron ore outlook. I would normally say coking coal was the same, but and it probably will be. Like, I think prices will come down a lot more than market futures have got right now for coking coal. But it's just there are supply disruptions on coking coal that are still, COVID related, especially in China. There are a lot of shutdowns from Mongolian coal and stuff coming in, and obviously rains in Australia and things. So, the supply side's still a bit constrained on coking coal, and so that may take a bit longer to come down. I still think that will fall, but perhaps not as critically as iron ore. So that ferrous sector looks pretty troubled, basically, coming out of this ongoing adjustment. I can't believe we can't get lower than $90 on iron ore if we're going to wipe out Chinese property. That just doesn't make sense. So that's the first market implication is for bulk commodities, and probably the largest. But there's a lot of base metals in Chinese property as well, and this is a big question right now in terms of things like copper and the energy transition that we're all kind of looking forward to over the next 10 or 20 years. And a lot of people are arguing there'll be a copper shortage and things. So Damo is going to give you a quick take on what we think happens with base metals as well.
Yeah, so
coming out of this.
So part of this, Wood Mackenzie, which is a big consultancy, put out a piece sort of earlier on this week, maybe it was the end of last week, just talking about how basically saying they didn't think there was enough copper to make the transition to energy, to renewable energy, and without massive spending and all these new mines coming on. Now, they're not basically, from what I can tell, really not making much of assumptions on what's happening in China and within copper and within the building industry, and also the slowdown in goods as well. So I've got a chart up just sort of showing where copper goes, and most of it goes into equipment and construction. So 60% of it, that's where it ends up. A lot of that equipment is your washing machines, your fridges, air conditioners, that type of thing. And then your construction is by and large, a lot of it really is based in China. So I feel like there was steel is obviously different. I think the numbers in China though for copper is still it is well, we can see here it's almost 30% construction of the world market, and China's been such a huge part of it. I think China ends up being sort of 18 or something percent of that, or 18 or 20% of that amount. So
of global consumption
of copper, yeah. And so if you sort of take into account, one, we've got this goods slowdown in terms of people rushed out and bought a lot of washing machines and fridges and all that type of stuff, and so that sort of drove copper demand. Secondly, we've got the construction slowdown in China, and we what it was 60-something% peak to trough. There is also construction slowdown elsewhere as well, and a lot of the I sort of look upon those two elements as being a little bit very related, in the sense that when people build a new house, they often then also buy a fridge and a washing machine and a dryer and all that type of stuff, which then uses that copper. And so the demand, part of that equipment demand is construction demand, but it's just that last little bit of people filling their house. And so so you take those ones out, and then all of a sudden the copper balance looks a little bit more shaky. There is actually a lot of new mines coming on at the moment. There's a bit of a gap in a few years' time, but a lot of new mines coming on at the moment over the next couple of years. The other factor then is that, well, I'll go into more detail in another podcast about the whole Wood Mackenzie and to sort of dig into it. But they've certainly made a number of assumptions, which are basically saying that all the energy transition is going to use the most copper-intensive versions that they can. So, for example, if you've got an EV and there's two different types of motors you can get within EVs. The switch seems to be towards the ones that don't use much copper. One uses sort of about 5 or 6 kilos of copper. The other one uses 25. Tesla, for example, has been going from the ones that use 25 to the ones that use 5 or 6. And so, depending upon what you assume, sort of going forward, that makes a huge difference as well. So I guess in terms of the copper side, despite despite the stuff out there that's saying we don't have enough copper, there's a reasonable chance in our view that actually we've got plenty, and it could easily be shortages over the next. Could easily be in surplus over the next few years if things keep going the way they're going.
Really good. So, just to kind of wrap us up here, we're on markets and political fallout. We wanted to look at how these various things are all coming together, and now we've got this overlay of the rise of the tyrant, and does that factor into these things? And I think I was kind of reassured over the last week by the market reaction to the end of the People's Congress, insofar as they've sold Chinese assets pretty aggressively after the apotheosis of Xi Jinping, and I think that's a good thing insofar as it's showing disapproval of his move away from liberalising policies and politics. Partly that's just a response, I think, to the lack of new stimulus announcements, yes, but it does very much raise the question of policy risk, of policy error, given Xi is now surrounded by old school yes men, and seems to have kind of grasped absolute power, and a lot of the new individuals that have come in markets are simply not all that familiar with, so
it's also that sign that they were moving prior to Xi. There was certainly this move towards more capitalism, more market power, and letting companies decide where to allocate resources. Whereas now that's very clearly going the other direction, and so I think there's people who are holding out, saying, "Oh, yes, losing freedoms, companies sort of hold, companies being forced to do things they don't want to do, but post-conference it'll all be fine, and we'll go back to liberalising and more capitalism," and that's obviously hasn't been the case.
Yeah. So you've got a number of factors, kind of bearish factors, coming to bear here, coming together. Pardon the pun. We have zero COVID, which is holding back a lot of the services activity in China. We've got this political adjustment. This property adjustment going ahead as well, with the trade shock to come, and that's creating this liquidity trap, and they're using fiscal to hold the economy up. But at the same time, they are being forced to ease monetarily, and where this is all coming to bear, perhaps most pointedly, is in the currency, in the yuan, where I think everyone's been surprised by how swiftly the renminbi has collapsed this year, and really ignored the conventions of PBOC containment for it, where it kind of runs this dirty peg and doesn't want volatility, particularly in the currency. It's been absolutely smashed this year, and there doesn't appear to be any end in sight to me for it, although it's just had a violent rebound. But that's indicative of ongoing volatility rather than any stabilization. So you can see the spectre of a Chinese external crisis in all of this, where you have these various bearish risks coming to a head in the currency, and the methods that are being used to offset them are to borrow a lot fiscally, and so you could see, if there's enough capital flight, the interest rates on that borrowing start to rise. I think they have been rather sticky this year, but we could actually see those yields start to rise in China, which makes it more difficult to borrow, obviously, and that can also flow through to more difficulty in the property sector if you're starting to get rising sovereign risk. And then overlaying that, now you have this extraordinary return to a centralized Marxist state, creating really intense sovereign risk on that borrowing as well. And so there's quite a doom loop here, if Xi overdoes, his his rhetoric and policy stances in terms of, Chinese looking outwards, if you like, on Taiwan, on trade, on various other geopolitical issues, the rise of Xi in the last 5 years to this preeminent position of power has clearly come with a sort of angry China and an increasingly bellicose China, prosecuting trade wars on Australia, for instance, that kind of thing. Obviously, COVID's played a role in all that too, but there is the spectre of a doom loop in this if the economy slows more than they can handle, and the response is political anger, that is, either to divert domestic attention away from a weak economy, or just in terms of policy error or arrogance, sweeping what is, a pretty arrogant regime, then, you get more risk appearing in China and more capital flight and less economic growth. And so, there is a doom loop in that if they mismanage it, and nobody really knows who this new Politburo is, particularly, other than the Xi cronies, and they've just embedded, kind of war on Taiwan in the Constitution, and so I think anyone that has any kind of reasonable geopolitical risk settings in their investment are going to get out of China ASAP. Like, I think it's borderline uninvestable at this point. And I'm obviously going to be, I think, a little more sensitive on this thing than perhaps the mainstream. But these factors are there. They're gathering momentum. And so it's possible this culminates in some kind of external crisis for China over the next 12 to 18 months. Maybe not, probably not, but that risk is there, which would just mean that all of this happens much more suddenly. A lot of the markets that we're talking about grinding lower would crash, and it would certainly derail broader equity markets and everything else, I think.
Now, haven't got heaps of time, Dave, but we do have a couple of questions. We might go speed round on questions.
Okay, we'll do speed questions.
Speed questions?
Yep.
Yes. Yeah. Go, Damo.
Yep. 3 red lines policy, deadline?
It's mid next year for all of the developers to meet the leverage ratios, but even if it doesn't get renewed, I mean, they will have met them. So there's no new leverage.
Yeah, that's right. Theoretically, yeah, it's unlikely they'll be saying meet these 3 red lines. Now they expired. Now go for it.
Yeah, go for it.
Yeah,
that's right.
Let's make 3 green lines.
It's the new normal.
Yeah,
So.
Yep. What's the broader strategic value of letting the crash happen in a managed economy? Is it something to do with China's global positioning?
No, I think it's more internal. I think that this is really about them trying to avoid the middle income trap and stagnation a la Japan. I just think it's too late and too big. So in that sense, I think they're doing the right thing, allowing that property adjustment, but they should have done it
10 years ago.
2015 at the latest, and probably never gotten into it after the GFC. And as a result, I think they kind of
they overcooked it on the GFC. I think it was worth doing, but I think they overcooked it.
Yeah, they probably overcooked it.
Yeah.
They definitely overcooked it. I think in a word, productivity is what it's about, but I think it's too late.
Yep. So China, if not property, where does China savings go, especially while currency being devalued?
Well, if I could answer that question, I'm
down.
Where do their savings go?
Yeah.
Well, I don't know. I don't know. I mean, anyone who can get their money out will take it out.
He's doing so.
Yeah, it'll go elsewhere, but that's not the rank and file, obviously. So where will it go internally? Probably the same thing we've seen over the last decade, where there'd just be bubbles will appear here and there, and maybe equities, maybe secondary market house prices. Like they may adopt the Western model.
Right.
Like, because what we're talking about here in the primary market in China is building new homes, but the secondary market's always been a kind of just afterthought for the Chinese. But maybe they can get it. They probably have enough headroom in households to do some more mortgage borrowing for existing homes. Maybe something like that. I don't know.
Yeah. I mean, on debt, on versus incomes and all that type of stuff.
Oh,
Sounds like
it's crazy.
Yeah, but you're just basically transferring the problem out of the property sector and into the consumer sector. You're saying,
yeah,
you guys have got too much debt. Let's transfer it across. Anyway,
yeah. Or it might all go into China's sovereign debt.
Yeah, I think this is possibly a yes/no answer. History doesn't repeat, but it rhymes. China looks like Japan 30 years ago.
Yes,
slightly different. Absolutely.
No, not different. Big yes.
Yeah. Well, no, there's a little bit of difference, but not.
Well, of course, but
yeah, but
it's
pretty similar.
Bigger and stuff.
But whatever Japan did, they just did more of it.
Yes, very similar.
Yeah.
And funnily enough, they actually follow a lot of Japanese policy dictates, in their development model. So, they kind of knew that this was happening, but did it anyway.
And
just the kind of momentum of inertia built into a system that made it difficult to turn in time.
Yeah, and it's a part once the winners, then get political influence. So your property developers get political influence, and then they then use that political influence to keep the whole thing going until it's too late.
So for me, that's actually a nice happy point to end on. I think it's great that China's going to turn into Japan because, yesterday or over the last few days, Emperor Xi has, declared that he'll rule the world by 2049. And it's not going to be possible if he's got a Japanese economy.
Yeah.
He'll never get the magnitude that he needs to pull that off.
And I guess the important point, though, from the Japanese example is there was a crisis, obviously, but it wasn't an acute crisis in the sense of it was long and drawn out. It's basically rather than saying let's have like a US style financial crisis where we just let everything burn and then we pick up the pieces and get companies going again. They were like, no, companies are all going to buy each other and the good companies are going to get some bad companies and settle them with debt and then just let that problem come out over 20 or 30 years. And you're just going to keep all this debt in the system and just push the problem out over 30 years and take a little bit every year rather than one big cathartic,
although I'm pretty sure the US didn't take all of it.
No, but
they did in households.
They do take a lot more than
they did. They did. Yes.
So, but I guess the net effect is it's a long drawn out bust rather than a sharp, really terrible bust followed by back to growth again.
Yeah.
Excellent. We might leave it at that, Sam. I'm sorry for anyone whose questions we didn't answer.
Yeah. Okay. Let's wrap it up. Thanks, everyone. We look forward to seeing you next time. Bye for now.